Well, good morning, everybody. Welcome back to Strongman Personal Finance. So I've noticed that there's a lot of investor interest in Lucid, which is an electric vehicle manufacturer, because EVs are the future and all internal combustion engines are going to go away. And we're going to be left with just a few winners about 10 or 15 years from now. And people are betting that this company, Lucid, is going to follow the same track as Tesla. If we all remember Tesla, it went from a fledgling company to one of the highest market capitalization companies in the world. And that market cap is totally justified. Okay. So let's go check out Lucid and why I think this company is going to zero. I think if you buy money, if you invest your money into Lucid stock, and you think of this as a long-term investment, I'm here to tell you, you're going to lose bigly. You need to avoid this stock 100%. It is only good for trading, which I do not recommend as well. So you might as well avoid it altogether. So let's check out the financials of Lucid. And I know financials are boring, but that's what I like to look at, because at the end of the day, I think financials and fundamentals do matter in the long run. Okay. So we can see Lucid's down 4% on the day, down 5% on the 5-day, up 38% on the month. So what the common mistake that retail investors make is they buy a stock and then it goes up in the span of a month or two, or even a year or two. And they say, well, the stock went up. There must be something, going on about this stock. There must be some positive catalyst. And they extrapolate the recent returns far into the future. And what people are doing is they're saying, this is Tesla. This is going to be the next Tesla. This is going to make me a millionaire. I don't need to max my tax advantage accounts and buy a total world index fund consistently over my lifetime. No, I need to buy Lucid. So the stock is up, okay, at least in the last month, which is drawing in retail interest. I'm here to tell you it's a fake and it's a trap. So currently this company is selling at a market capitalization of $9 billion. You could buy the entire company for $9 billion if you had that much. Now, the first red flag that I see is that this company has a price to sales of 9.54. What this means is you're paying $9.54 for $1 of revenue, of trailing revenue. Think about that. Revenue is at the top of the income statement, the very top. It's before any expenses. You're paying 9.4 for $1 of revenue, not $1 of profit. That's a big one right there. Companies' valuations and multiples can expand. That doesn't mean you bought a good stock. You could be in the middle of a bubble or a euphoria. That's what I think's going on here. Okay. Now, if we go look at the income statement, which is their profit and loss, the first thing you notice is that their revenue is growing pretty significantly. Okay, their most recent quarter, they posted $200 million of revenue. That's amazing, right? Their revenue grew 45% year over year. Bullish, bro. An investment is all about profit. A company profits, and they return some of those profits to you through various means. They can buy back shares. They can pay a dividend. They can pay off debt, which increases earnings per share. They can reinvest back into the company. That's how you get rewarded for owning a profitable company. A company that does not make money is getting money from external sources, which packs on debt, or it dilutes current shareholders. That's a big problem. Look, right off the bat, what do we see? Gross profit. So they generated in the most recent quarter $200 million of revenue. $200 million of revenue. That's just sales before any expenses. They lost on the top of the income statement $212 million. So for every car they sold, they basically paid twice as much. They spent twice as much on the car as they sold it for. Their cost of revenue, the cost to make those cars that they sold, was $412 million. So if you sell a bunch of cars for $200 million total, but you pay $412 million to make the cars, you lose $212 million. And that's before selling, general and admin, research and development, interest and taxes. You starting to see the problem here? Why is this the case? New companies They build out huge factories because they expect to fill those factories with a bunch of cars that they're going to make. But when it comes to accounting, when you build a factory, you have to allocate those costs to the inventory, which is the cars that you're producing. And when you don't have a lot of production, the total cost of the factory is allocated to a few cars. And when you sell the car, you recognize that expense of making the car when you sell it, when you deliver the car, when you pass control of the car to the buyer. So a lot of the expenses are going to be sitting on inventory. And when you sell the inventory, that's when it hits the income statement as cost of goods sold. Lucid, every time they sell a car, is basically losing 100%. Okay, they literally pay double what they sell the car for to make the car. On top of that, selling general and administrative expenses, paying the staff, marketing, $233 million. Their selling general and admin was higher than their revenue. Research and development, $324 million. You starting to see how it adds up? Their total operating income was negative $770 million. In one quarter, they lost $770 million from operations. That's pretty bad, okay? Now, they have some interest in investment income, and they have other non-operating income, which we can see that in the financial statements, for a total loss before taxes of $983 million in one quarter. Almost $1 billion loss. Do you see the problem here? Are you looking at the stock price or are you looking at the fundamentals here? Now, let's go look at shares outstanding. So, the more you issue shares, the more your current ownership gets diluted. What do you notice about the share count of Lucid? It's going up and up and up. Why? Because they're burning cash. They're not making positive cash flow from selling cars. So how do you get cash? Well, you're not making it from selling, so you got to raise it somewhere else. You got to issue stock. This company is issuing stock over and over and over again because they're burning cash. That's a big problem. They're not buying back shares. They're not paying a dividend. I'd be shocked if they were paying a dividend. That would be negligent. They are taking in capital. It's bad, okay? Now, their total current assets, they currently have $4.2 billion of current assets, of which $3.4 billion is cash. And you may say, that's good. They have $3.4 billion of cash. That's a big number. That's a huge number, bro. However, if we go look at their statement of cash flows, in the most recent quarter, they burned $462 million of cash from operations, and they spent $159 million of capital expenditures. For total cash outflows of maintaining their equipment, investing in new infrastructure, and selling cars, they burned $622 million in 3 months. So their burn rate is, if you annualize it, if you look at it on a monthly basis, is roughly $206 million, $207 million a month. So if you go look at their cash, well, let's go look at their cash and cash equivalents. 3.4. So if you're burning $207 million a month per year, that's $2.4 billion they're burning in a year if you average it out. And it could get worse. It could get worse. So how quickly do you think they're going to deplete their cash balance? Probably within a year and some change. And if things get worse, they're going to burn it faster. And what are they going to do with the cash balance? They're going to have to issue more shares or go into debt. Let's see if they've been packing on debt. Let's see. All right, long-term debt. So far, they haven't issued a lot of debt. I mean, they have $2 billion of long-term debt. $2 billion. And that's going to come due one day. But what they've been doing is relying on share issuance, it looks like mostly, to keep their operations going. So let's see. I mean, they're paying off some debt because they have to. But they've basically been relying on share issuance. So the last big share issuance event, they raised $3 billion in the second quarter of 2023. And from that $3 billion, they've burnt through probably almost all of it or a significant portion of it. And what are they going to have to do again? They're going to have to issue more shares. What's the problem with that? Well, the stock price has absolutely collapsed. Now, if you look back in 2021, 2022, which was not a bubble, guys. I mean, just vertical lines everywhere. Their share price was very high. So when you have a very high share price, you can issue stock and get a ton of money for each share that you issue as a company. So you can raise a ton of capital if your stock's in a bubble. What happens when your stock price collapses? Well, they can only raise, at best, $3 for every share they issue. For every share. And what will happen is the stock price will collapse more if they do a massive share issuance. So let's think about this. For every car they sell, they pay double for it. They're burning $200 million a month in operating cash flow and capital expenditures. Their share price has collapsed to $3 per share, which means they are going to have issues raising additional capital. They're already $2 billion in debt. The economy, I mean, it looks great on paper, but when you look at interest rates, these are expensive cars, isn't doing too well. And this is a high-end company, okay? They charge a lot of money. So in the most recent quarter, they delivered 2,781 vehicles, and they produced 1,805 in a quarter. So if you take their $200 million of revenue and you divide it by the number of vehicles they delivered, every vehicle on average was $72,000. Can you imagine buying a $72,000 vehicle with the interest rates that we have right now? This is not going to be a huge market share company. Okay. The reason that Tesla was able to thrive was the stock went up massively in a bubble, and they were able to issue a ton of shares and basically fortify their balance sheet. Lucid is past that point. We're no longer in a EV clown market, except for Tesla's in a clown market bubble. But we're no longer in an EV hype phase. And in hype phases, you can issue a lot of shares as a company to raise cash. That's past for them. This company will most likely go to zero. And on top of that, look at this. Subsequent to the third quarter, they completed a capital raise of $1.75 billion. So they fortified their balance sheet a little bit more, but think about how many shares they had to issue. So if you're a current shareholder, your ownership of the company's future profits, which I think are never going to exist, has been massively reduced. So your future returns, when you look at all the cash you're going to get in the future, you're burning cash as a shareholder for the foreseeable future. And then maybe, just maybe at some point in the distant future, this company will start having positive cash flow. But with the time value of money and your opportunity cost, and you discount those future cash flows, you're not going to make a positive return on this company. Probably forever. What's most likely going to happen is it's going to go to zero. Okay? So once again, everybody looks at the vertical line. It's up 38%. Oh my God. Time to buy it, bro. But in the long run, this company is going to go to zero. That's my humble opinion. Let me know what you think in the comments. Let's book a free consultation. I'm a certified public accountant. If you want me to do your 2024 taxes, business or personal, book a free consultation. I'll talk to you for free. I'll give you an upfront quote. I do all businesses, all states in the United States, LLCs, C corporations, S corporations, partnerships. I could probably beat your CPA. I don't have any expenses, and I'm just the coolest CPA you've ever known. Strong man, real U.S. stocks, bro. I saw a few Lucid cars at the mall. Oh, well, never mind. I'm bullish now. It's doing vertical. It's going up. You were wrong, strong man. You're wrong, bro. Retail investors are like greyhounds. They chase anything that moves. That is true. They're like, I call them moths. Cash subsidies, they are nice. I mean, the cars are probably nice. Like a $72,000 car, it's probably a nice freaking car. Okay. But in the long run, that doesn't mean anything. This company is going to go to zero. That's my humble opinion. So thanks for tuning in. Like, subscribe, book a free tax consultation. I'm a CPA. I'll do your taxes for 2024, business or personal. What's to lose? It's a free consultation. Have a wonderful New Year's Day. Cheers.